Good evening, everyone. Welcome to our live sharing class tonight. Thank you, everyone, for all your support from our members. I will do my best here to share with you all the knowledge and experience I've accumulated over the years. It is also a process of learning together. I will regularly bring to you the ideas and methods of the world-famous trading masters, hoping that all the people here can not only earn substantial profits, but as well as learn the most advanced trading mindset and successful strategies worldwide. During this learning process, it not only helps to improve personal trading skills and strategies, but also help to remain rational and steady in the complex and ever-changing market environment. Now, at the same time, it can also enhance one's trading abilities and investment returns in the continually changing market, achieving more and robust, successful investment career. Now, without further delay, let's officially start today's lesson. So, jumping right away into our contents, I'm going to be going over what is in store for us this evening. So the contents to be shared tonight have some slight changes compared to the classes before. So we will no longer conduct the individual stock analysis in the live sharing classrooms, meaning we will not be recommending those stocks so that we used to be recommending. Now, a lot of you ask, why is that? Because our focus in the later stage will be on the trading of the wealth growth plan. After all, the profits brought by the wealth growth plan are stable, and it is for certain. In the process of comparing asset management skills in the four regions of the Asia Pacific, it would be counterproductive if we put too much emphasis on the ordinary stock market. And as you all know, there's been a lot of volatility, and it's just rebounded recently. So I have always said that if many of your friends incur losses from buying the stocks that we've recommended earlier, they can always contact my assistant for registration. Now, we will arrange for additional compensation in the wealth growth plan to help you recover the losses. In fact, you can also see from the records that we have made a lot more profit from the stocks, right? However, do not worry. As long as you report it to the assistant, we will help you earn additional profits. Now, in the previous sessions, we mainly shared some content about the concepts of renowned international trading masters with everyone. Tonight, we will not only share the trading concepts and experiences of a master, but their practical trading methods. So, does everybody sound pretty interested? All right, exciting content is about to be presented, so let's continue for the day. Okay, we are going to start with the analysis and the sharing of major news and financial data, as well as the fundamental aspects of the macroeconomic news. So the content about major financial news tonight may seem a little bit insignificant at first glance. However, every night, every class, I will share with you different perspectives to analyze the relevant content. This is a matter of thinking. If your thinking is broadened, not only can it be used for market analysis, but it can also be applied in daily life. All right, so let's move to the first one. Okay, so first one is India Central Bank's record dividend to government may reduce fiscal gap. Now, according to the reports, the board of the Reserve Bank of India has approved a record transfer of 2.11 trillion, which is equivalent to 25.3 billion US dollar surplus to the government in the fiscal year ending in March, far exceeding analysts and government's forecasts. Now, the midterm budget estimate that the fiscal year 2024 to 2025 indicates that the government has budgeted for dividends worth only 1 trillion from the Reserve Bank of India, state-owned banks, and other financial institutions. The dividends from the Reserve Bank of India are advantageous for the government's financial situation, said the Finance Minister Somanathan. With this move by the Reserve Bank of India, it can be said that the government's finances will become even more comfortable. So, what does that mean for us? When the national finances become more comfortable, it usually signifies that the government has more financial resources to allocate towards economic stimulus and public investments, which we will have various positive impacts on the Indian stock market. Of course, these impacts are gradual and they're not immediate. So, first, with improved financial resources, the government can increase investments in infrastructure construction, technology innovation, and other sectors as well, which can stimulate the development of related industries, increase employment, and resident income, ultimately promoting economic growth. The improvement in the macroeconomic environment generally benefits the overall performance of the stock market. Additionally, a comfortable fiscal situation usually enhances market confidence. Investors will have more confidence in the economic outlook, leading them to invest more funds in the stock market, thereby driving stock market growth. Second point, if a comfortable fiscal situation means a decrease in government debt levels, the government can reduce debt financing pressure, lower interest payment burdens, which help stabilize the economic environment and improve the stock market performance. Countries with comfortable finances usually attract more international capital inflows, and these funds may flow into the stock market, boosting the stock market performance. Now, in fact, recently substantial outflows of FIIs have been observed. Therefore, a comfortable fiscal situation may play a positive role in attracting these funds back. Now, of course, it is important to note that this positive impact is certainly gradual, but it's going to be steady. It will strengthen the long-term bullish sentiment. However, please be aware that this effect may not immediately alter the current short-term market trends. In the current market scenario, rebounds will still happen when they are due and fluctuations will persist. So that's a great piece of news. Everything about dividend bonuses and things like that, when the banks and the government has a great fiscal year, they have more money to pour into their economy. So economic growth is what we always talk about. We want the economy to be growing well, so then the stock market can perform better as well. Okay, so on to our Western counterparts. So let's take a look at the news from the American real estate sector again. Now, due to the rise in mortgage rates and pressure from rising house prices, existing home sales unexpectedly declined in April, causing the real estate market to suffer setbacks once again. In April, existing home sales fell by 1.9%. Housing inventory increased by 9% to 1.21 million units. The median house price rose by 5.7% to about 407,000 USD compared to the same period last year. Now, I want to go over this part a little bit. So if you think about home sales falling by 2% and then the inventory increasing by 9%, we're starting to get a bigger and bigger gap, right? Now, despite the report from the National Association of Realtors on Wednesday showing an increase in inventory to a 2 to 1.5 year high last month. Now, entry-level homes are still scarce, leading to a consecutive second month decline in sales due to the rise in mortgage rates. Residential investment in the first quarter, including home construction, achieved the fastest growth in over 3 years, followed by a subsequent downturn in the real estate market. Now, you may wonder how the decline in the American real estate market will impact our stock trading. if it had no impact, why would I be sharing this news with you? So let me share my thoughts with you on this. So generally speaking, a downturn in real estate market is negative for overall economy. I've always emphasized the need for a dialectical approach when looking at these issues. Now, things that seem bad on the surface may not necessarily end up being bad, and things that seem good on the surface may not necessarily be good in the end. So let's take this decline in the American real estate market as an example. For us financial traders, isn't the biggest dynamic factor in America currently about when to cut these interest rates? So this is for certain. A downturn in real estate will have a negative impact on the overall economy. Is a rate cut a very good policy tool to stimulate the economy or the real estate market? Overlapping with the earlier slowdown in inflation data also supports the Fed's rate cut. Although a real estate downturn may be one of the many factors prompting a rate cut, quantity change will eventually lead to a qualitative change. Has this event added weight to the balance of the rate cuts in the US? Now, the answer is obvious. In fact, through this case, my ultimate goal is not about this case itself. It's not about the real estate, but it's to encourage a certain change in everyone's way of thinking. So when you see this kind of pressure in an economy where the real estate market is starting to be hurt, so that is going to give more pressure to the governments to lower their interest rates, and that overall will impact everybody, right? Okay, jumping into our performance of the Indian domestic stock market. Now, the key stock market indices in India, is the Nifty 50 and the Sensex, closed at a historic highs, with both indices achieving a significant increase of 1.6%. The weighted stocks of the indices led the surge. Now, the banking sector was the best performing sector in today's trading. Today's market had both positive and negative factors. The biggest positive factor was the Reserve Bank of India distributing a record 21.1 billion rupees dividend to the government, which will provide an additional fiscal space of 0.3% of the GDP for the government. So this is why I went over the little bit of a news, because it's going to come into this. Now, this means that the government can reduce fiscal deficit and increase infrastructure spending. Now, we have already shared this information with everyone earlier, so I'm not going to repeat it here again. Additionally, the morning speech by Modi also played a significant supportive role. Overall, in the past 2 months, the performance of the Indian domestic market has lagged behind other emerging markets. The recent rebound in the past few days and today's significant increase has finally restored the glory of the Indian stock market. So let's take a closer look at the trends of the Nifty 50 index as well as our Sensex index respectively. Here we go. So taking a look at our Nifty 50 first. Now today, driven by numerous positive factors, the Indian stock market soared overall to break through and hit a historical highs in the stock market. Now, major industries like banking and automotive performed exceptionally well. The Reserve Bank of India's record dividend is akin to an indirect rate cut, expected to lower bond yields. The market remains active, and the HSBC Composite PMI data for May showed strong economic expansion. The early arrival of the southwest monsoon has provided a boost to the domestic market. Now, looking at the technical chart of the Nifty 50 index, since January this year, the index has been on a fluctuating trend. Now, although there is an upward channel feature on the market, the oscillating nature remains consistent. Now, it can be said that this oscillation lasted about 5 months, and in terms of time, after nearly 5 months of oscillation, consolidation, and reliability of the upward breakthrough is very high. Now, on the other hand, the index's increase today is quite significant, showing extraordinary bullish strength in the market. In terms of trends, Today's upward breakthrough of the Nifty 50 index surpassed the previous two highs at 22,800, finally breaking through the resistance of our previous high. So the most important question now is whether this kind of upward momentum can it be sustained? Now here it can clearly stated that based on the technical chart, such a strong breakthrough often carries inertia. So in the short term, inertia in the upward trend will still prevail, although the short-term gains may not be too significant. As the upward breakthrough is significant, regardless of how much price rises in the short term, ultimately there will be a need to confirm a downward retracement. Once the market truly confirms the technical retracement, it often marks the true buying opportunity. So overall, with one trading day left to this week, the market trend for this week has been largely confirmed to be focused on maintaining an upward trajectory. So this week has been positive. The past few days of trading rebounds have been nice. We're finally picking up some momentum. So moving on to our Sensex. Let's continue to look at the Sensex index. Now, today, the index also saw a breakthrough upwards. Although the extent of the increase was similar to that of the Nifty 50 index, however, the closing position of the Sensex index today was slightly closer to the breakthrough point in price. Now, nevertheless, there is no need to worry, as ultimately its trend will remain consistent with that of the Nifty 50 index. So, from the technical standpoint, the Sensex index broke through upwards today. It is important to note that this was a breakthrough of previous high point, moving forward, maintaining the upward channel for almost 5 months. The upward channel line may act as a resistance level for the index price. The market trend may continue to rise in the short term. Once it reaches the upper edge of the channel, a pullback for confirmation may occur. After the confirmation, it may resume the upward trend. So if this inference holds true, it can be considered as supporting evidence for the analysis of the Nifty 50 index. Although the Sensex index may not be as perfect as the Nifty index, a breakthrough remains as a breakthrough, which is undoubtedly confirmed. Now, some people may have a reflex to immediately follow such a breakthrough. However, my opinion remains cautious against impulsive actions. To be honest, the index does exhibit an upward breakthrough. Even though the stock market may present good opportunities, they can't be compared to our wealth growth plan, as both the profit margin and growth in our wealth growth plan are very high. All right, we have provided a brief introduction and shared the comprehensive analysis of our two major indices. I hope it's been helpful. So let's continue learning in the next part. Okay, so into our asset management scale competition. Now, everyone should know that our wealth growth plan has entered its new stage. In fact, this is also a more important stage for the competition in selecting the Asia Pacific headquarters among our 4 regions. Now, why do we have this wealth growth plan? Many members are already very clear about this, but because only when we all make money and earn more money, the funds in our asset management accounts will grow. And then the scale of assets managed in the India region will increase. So here I want to thank everyone once again for their support. Many people have shown great support and excellent execution in the trading process so far. So thank you all. We've been comparing the scale of our asset management for over a week now. Although our ranking was not high before, I didn't care that much at all. Now, why, you may ask? Because only by accumulating more profits now, our future explosive power will be even greater. So we're currently in the stage of laying the foundation. Now, of course, I hope that all of us can earn more and more profits at this stage and lay a more and more solid foundation. Yesterday evening, a friend said that since joining the Wealth Growth Plan, our profit has already reached 100%. Now, isn't that great news? We are already at 100%. So please cherish the current opportunity because the more you earn now, the larger your capital base will be. With a larger capital base, you can earn more with the same profit margins. Now, here's a simple example of what it means for base capital, right? So, if we had a base capital of 10 million, 10% is going to be 1 million. Both earning a profit of margin of 100%, which one earns more? So, whether you have 10 million or 100 million, if we were to double that, which one's going to make more? Of course, the 10 million. So, the more we have in our base, the better it's going to be. Now, you also know that we have new projects in negotiation. Once the negotiation is successful, all the details are confirmed, we will implement it immediately. Now, why wait when you can earn more profit now? You also know that the trading volume on Friday has increased, which means you can use more funds to earn profit. Now, I'm not going to elaborate on this. Everyone should manage it themselves. So, everyone, you should have earned good profits through the block trading from yesterday. The next block trading time is going to be on Friday. So, make sure you make an appointment in advance with the assistants to prepare to be buying more shares. Ultimately, our goal here is to make money, right? So, let's get ready. Okay, so next I want to continue to share a little bit aspects more on IPO subscription. Now, many people are very interested in this section, the IPO section. And of course, there are also a small number of members who are not very familiar with this. However, it doesn't matter. As long as it is something everyone is interested in, I will arrange time to share it with everyone one by one. So, why are people very interested in the content of IPO? So, first of all, as long as you can get allocated during the IPO subscription, it usually means absolute profits. So, another way to gain absolute profits is to earn allocations for the IPO. It's just a matter of how much profit. Now, when you subscribe normally, the chances of getting allocated are very, very low, meaning you may participate in this subscription but end up with nothing. So let's not talk about the first aspect for now because this is basically guaranteed profit. Today, I want to share with you some tips about IPO subscription that can help increase the chances of getting allocated when subscribing to an IPO. So first tip, increase the number of subscription accounts. Now, how do you do this? You can increase the total number of accounts for subscription by using family members, such as your spouse, parents, siblings, so forth, right? Secure these accounts for subscription, thereby increasing the chances of getting allocated. So number one, increase subscription accounts. Number two, increase the subscription quantity. Now, this is a principle everyone knows. But please note that while increasing the subscription quantity, ensure that there is enough funds in the account for the subscription. So if you want to subscribe for 10,000 lots or 10 lots, make sure you have enough. But go for quantity, right? Now, number three, strategic subscriptions. Now, how to go about this one? So first, submit subscription applications at different times on the subscription day to avoid subscribing at the same time as a large number of investors. So thus increasing the chances of getting allocated. Now, secondly, the earlier the subscription, the better. Number four, increase market value. Now, in some markets, the chances of getting allocated in IPO subscriptions are related to the market value held. Investors with higher market values usually have a higher chance of getting allocated. So maintaining a higher holding market value can increase the subscription amount and therefore increase the chances of getting allocated. Now, the above are just some of the tips for IPO subscriptions. They may not be comprehensive, but that's okay. I will slowly share more with you in the future as well. So we're going to be moving forward after the IPO. All right, back into some analysis techniques. So let's start learning about the important topic, the 1, 2, 3 rule. Now, this rule combines theory and practical application. Earlier, we studied the Dow theory, which is the most fundamental and foundational theory in the technical analysis field. Do you all still remember? If you do, you should know that the Dow theory is the origin of all technical analysis. So, in other words, the majority of technical analysis theories or schools in the current market are developed based on the Dow theory, and this is a remarkable theory. So, today we're going to continue to share with you theories and methods that can be applied in actual trading processes, and this one is called the 1-2-3 rule. It is a practical strategy that directly emerged based on the Dow theory. So let's start to get into details and share this part of the lesson. So the first question that we're going to ask ourselves is, how did this 1-2-3 come about? Where's the origin of this? Now, the 1-2-3 was invented by an American trading master, Victor Sperandio. Now, based on the Dow theory, he simplified the complex and arduous task of trend recognition, forming the 1-2-3 rule. Now, we mentioned Victor Sperandio here. Have any of you heard of him before? He is a very formidable figure in American trading history. So, Victor, a professional securities trader, a prominent figure on Wall Street, was once praised as the Wall Street Terminator by Barron's. So from 1978 to 1989, he made profits for 12 consecutive years without any losses. Consequently, his 1-2-3 rule has been highly sought after by many investors, even up until now. So it is for this reason that I'm sharing this content with you. So let's continue. Now, before we dive into Victor Sperandio's principles and methods, let's first get to know what kind of person he is. This master is most famous for predicting the stock market crash of 1987 in a widely covered interview in September 21st issue of Barron's. Now, on October 16th, trading day before Black Monday, Sperandio shorted the Dow Jones Index and made a profit of 300% on the day of the crash itself. Everyone, do you think it's difficult to make a profit of 300 or even 500% during trading? It's actually not difficult at all. Sperandio made 300% in a day. Can't we achieve it in a month? Maybe in 2 months? Can we earn 500%? Of course, it's achievable. Now, Victor was born in Queens, New York, and from a young age, he was passionate about taking risks and making money in his teenage years. So Victor developed a strong passion for playing poker. Sorry, my throat's dry. Now, he realized early on that the key to winning in poker is managing the odds. Although he played poker quite well, he didn't want to become a professional poker player. At the age of 20, he decided to enter the job market in New York. Now, the profession of off-exchange trading caught his attention, and he thought his poker background might be helpful to him. So he decided to chase this profession. So later, Victor admitted that engaging in a trading career was the best decision of his life. Now, Victor is one of the legendary traders on Wall Street. With over 45 years of successful experience in Wall Street, Sperandio independently trades with his own funds and represents the top personalities like Leon Cooperman and George Soros, among other famous investors. He has managed future trading for global investment banks like EAM Group, HSBC, Royal Banks of Scotland, and Nomura Securities. This guy is impressive, am I right? Now, in addition to the 1-2-3 rule mentioned above, Victor Sperandio also insists on following specific rules that can help investors achieve stable returns and avoid mistakes, especially in the long run. So, what are these rules that he adheres to? So, let's take a look. First, rule number 1, trade with a plan. Victor says that when trading stocks, it is crucial to have a well thought out plan and stick to it. This is absolutely true. And I tell my students and everybody here all the time. He believes that confusion is your greatest enemy because it can trigger emotional reactions that can harm your performance. Creating a trading plan and sticking to it can help you better navigate periods of market volatility and avoid taking on high risks. Rule number 2, the trend is your friend. Now, this statement is actually very easy to understand. So we often say, go with the trend, don't we? Go with the flow, go with the trend. It's essentially the same idea. You can think about why many successful people can succeed with their methods and rules, even though they are not mysterious. Rule number 3, use stop loss orders. Investors often find it hard to determine when the market turns against them. Now, this is why many traders fail to exit trades on time, leading to significant losses. One of the safest ways to avoid this situation is to set a stop loss order. Everyone knows about this, so we're not going to dive into it a little bit further. Rule number 4, if in doubt, get out. Victor strongly recommends that the odds be in your favor. He says that if the changing circumstances are not in your favor, it's better to exit the market. So, very easy to remember these rules. Rule number 5, avoid overtrading. Say this numerous times. Sperandio has been using not too many overtrades, right? He's been using this rule for so long. So, investors should patiently wait for a suitable opportunity and take action only when a maximum number of factors are in their favor. Now, these are the rules that Victor has been using. So if we just take a quick look at them, it's not difficult at all. It is actually not that difficult at all. So the key is in the execution, which is why I always emphasize the importance of having a strong execution power. Come up with a plan, stick to the plan. If you see a good trend happening, they are your friends, so follow the trend. Don't go against the market. Set some stop losses so it helps you with risk management. If you are uncertain, it's best to just get out. These are very, very easy, and don't overtrade. Don't be in everything, right? Okay. So now let's talk about the rule, the 1, 2, 3 rule. So what exactly is the 1, 2, 3 rule? Now these numbers or this name may look very simple, and sometimes in life we often find that the simplest methods are often the most applicable methods. The 1, 2, 3 rule is essentially a rule for judging trend changes. It is essentially buying on dips in an upward trend and selling short on rallies in a downward trend. The 1, 2, 3 rule is universal and is widely used in major financial markets, such as stock market, the foreign exchange market, and the commodities market. So why is it universal? Because the 1, 2, 3 rule is based on the application of trends. Just think about it. Isn't trend a word that we always commonly mention when we're in trades? Or is it most commonly used methods or means? So trade with the trend considered the highest trading principle. Now the answer to all of this is self-evident. So let's continue further. Now the 1, 2, 3 rule, these few words are very simple. So what do the numbers 1, 2, and 3 in the 1, 2, 3 rule represent? So if we do not explain this question clearly, it will be impossible to discuss the application later. So first, in the 1, 2, 3 rule, the 1 represents the price breaking through the trend line, which symbolizes the end of the original trend. So the original trend has ended at the 1. So if the stock breaks above the trend line, the downtrend ends, and if the future trend is bullish. Now this is the first buying point. If the stock breaks below the trend line, the uptrend ends, and the future trend is going to be bearish. So this is the first selling point. So second one, the 2 in the 1, 2, 3 rule represents the price probing back in the original direction, but without making new highs or new lows, confirming the end of the original trend. Now, if the probe downward does not make a new low, it indicates that the downtrend is confirmed to end. And this is the second buying point. If the probe upwards does not make a new high, it indicates that the end of the uptrend and is at the second selling point. So what ends up happening is if it doesn't break past its previous support or go past up its previous high, then it's going to continue to go that direction. Number 3. So the 3 in the 1-2-3 rule indicates the formation of the new trend, which is a signal of the trend reversal. Now, if the stock price does not make a new low in a downtrend, but instead makes a new high, it indicates a reversal from a downtrend to an uptrend. So now we're going up. This is the third buying point. If the stock price does not make a new high, but instead makes a new low in an uptrend, it indicates a reversal from an uptrend to a downtrend. So this is also the third selling point, right? So through textual or spoken or by me speaking, everyone kind of doesn't have a clear understanding of the 1-2-3 rule. So I'm going to be going over graphs. So let's talk about these slides. This is the diagram of the 1-2-3 rule. I have used two illustrations. One shows the 1-2-3 rule within an uptrend, and the other one shows the 1-2-3 rule within a downtrend. Now, before we proceed, I want to clarify one thing. In the upcoming explanations, our focus will be on discussing the 1-2-3 rule within a downtrend because it helps us identify buying points. Okay? So the 1-2-3 rule within an uptrend is primarily useful for finding selling points or shorting in a two-way trading market. Today, our emphasis is not on two-way markets, so we won't dive into that aspect. So let's focus on the left side of this diagram, which represents the 1-2-3 rule within the uptrend. Now, while the right side illustrates the 1-2-3 rule within a downtrend, remember our definition of the 1-2-3 rule from earlier. If you do this, you should be clear, right? So now looking at the 1-2-3 rule within a downtrend on the right side, the 1 represents breaking above the downward trend line in the red. Now part of the 2 involves the retracement, so it kind of bounces back. Involves a retracement to confirm, but during this retracement, no new low is formed. So the low point formed during step 2 is a secondary low. 3 marks the end of the retracement and another move upward, surpassing the high point of 1, indicating a new high. Now, at this point, we can say that the previous downtrend has concluded and a new uptrend has begun. However, the future duration of the extent of the uptrend is not within the scope of the 1-2-3 rules analysis. Okay, so if everybody takes a look at the right side, so you see the 1, we go up and then we go down. But when we go from 1 to 2, we don't break past the bottom line, and then we go back up, and then the 3 goes past the 1. That is your 1-2-3 rule. Okay, so let's take a look at the application of the 1-2-3 rule in practical trading. So first, in the market downturn, when the stock price breaks through the downtrend line and retraces before breaking through the previous rebound high again, that's when we buy. Now, this kind of buying is the most prudent method and also the method with the least amount of risk. Is it possible to buy when the stock price breaks through the downtrend line? Of course. In the 1-2-3 rule, when the retracement of 2 does not produce a new low, this is very key. It cannot go past its previous low and rises again. Can you buy? So we can buy it. It's that when 3 reaches a new high, buying at this point accompanies the emergence of new uptrend, making the risk of buying here the lowest. Second, in an uptrend market, if the stock price falls below the uptrend line and drops below the previous low after rebound, then we sell. Now, this method is usually used in the stock market as a judgment opportunity to exit stocks. Okay, so when we were explaining to everyone, we all use standard text book style graphics. However, in actual trading analysis process, the market does not always represent standard patterns because when people see patterns, everyone recognizes them and can operate on them. So as long as you've learned the 1, 2, 3 rule, there will inevitably be some non-standard patterns appearing in the market, which are variations of patterns. This is also why I have always been urging everyone to apply and learn actively. So not learn rigidly. When standard patterns appear in any tactics or methods, of course it's great. Like if we see a pattern like this on a chart, we just follow it, great, it's easy. However, when some non-standard pattern cases occur, we should also know how to operate. So let's take a look at these patterns. I briefly listed some variant patterns, which certainly belongs to the type of 1, 2, 3 rule. However, they do have some differences from the standard pattern we learned earlier. Now, I'll leave a question here for you all to think about. When we encounter these variant patterns in the actual trading process, how should we respond? Or what strategies should we adopt during the actual trading process? I'm not going to give you the answer to this question because there is no standard answer. Why? Because everyone has a different trading style. Some are conservative, some are aggressive. The strategies for traders with different styles are not the same, but no matter what trading style you have, you can find one or several strategies that is most suitable for yourself. It's enough to achieve at this level. Now, why is the 1, 2, 3 strategy so popular among many traders in the market? This is definitely inseparable from the advantages of the 1, 2, 3 strategy itself. Now, the 1, 2, 3 strategy is a simple but very practical buying, selling strategy, and its advantages are very obvious. It is manifested in the following aspects. So, number one, the larger the time frame, the higher the accuracy and the greater profit potential. Now, this is very obvious because we all know that in a shorter time frame, the more noise there is in the stock price movement process. So if you apply this to a larger time frame, you will naturally ignore all the noise in the market, all the volatility, all the oscillations, right? So if you focus too much on a small time frame, this distraction will instead affect your normal trading. So ignoring the noise will definitely lead to a higher accuracy and, of course, greater profit potential. Number two, this strategy mainly captures trend trading opportunities and it does not focus too much on short-term trading opportunities. In fact, this is somewhat similar to the previous point, as we mentioned. Short-term trading focuses on a shorter time frames, so distractions and noises cannot be completely eliminated, thereby affecting your win rate. Number three, it's simple to learn, highly practical. This point is very easy to understand, so we don't need to talk too much more about it. When you look at the 1, 2, 3 rule, you can kind of captivate it right away. So earlier contents about the 1, 2, 3 rule are just some of the specific things. No matter how much we talk about it or how refined we are, it ultimately depends on how to apply it in practice. So next, let's talk about the application of the 1, 2, 3 rule in actual trading process. So first, look at its primary application method, which actually comes from the definition of the 1, 2, 3 rule. So the first method is to buy at the first time after the stock price breaks through the trend line upwards. For this kind of method, it is actually the one part in the 1, 2, 3 rule. So taking this chart as an example, this is a pattern case I randomly selected as per the 1 in the 1, 2, 3 rule. We should buy when the stock price breaks through the descending trend line. When we buy, we cannot accurately predict how much it will rise in the future or at what pace it will rise. We only know that such purchase is correct. In line with the 1, 2, 3 rule strategy, as long as a strategy has a high success rate, we do not care about the profit or loss situation a few times because we know that as long as we persist, This method will definitely bring us profits. So this is our buying time right here. Okay, number 2. So let's take a look at the second method of the 1-2-3 rule. In the basic application, the second method is to buy when the price retraces again after the 1 of the 1-2-3 rule, but does not make a new low, which is when the 2 of the rule is formed. It may be difficult to understand this explanation, so let's directly look at this graphic. In this graphic, everyone can see the 1-2-3, right? So our second method is essentially to buy when the 2 is formed, which means to buy when the price retraces after the 1 is formed, but does not make a new low. So this is when it doesn't go past the new low. One detail to note here is that when I mark the 2 is actually near the lowest point of the retracement. However, in actual trading, we often wait for the price to start rising when the 2 is forming before taking action, or we wait for a significant bullish candlestick before taking action. So when we buy at the end of the 2, many times the price may retrace further after our purchase. We must be prepared to accept such retracements. Now, some people always hope that after buying, the price will just keep rising without ever turning back. This is an ideal scenario that everyone wishes for, but the reality is often different. In our journey to successful trading, there will always be some challenges and even some costs of trial and error. However, as long as we stick to a high win rate trading strategy, we can achieve long-term stable profits without worrying about occasional mistakes. Okay, so let's take a look at the third method in this basic application of the 1-2-3 rule. The third method is to buy after the price breaks above the previous high point and after a pullback. At the time when the 3 in the 1-2-3 rule is formed, everyone pay attention to this chart, okay? So when the price breaks above the previous downtrend line, from the bottom, it forms the 1 in the 1-2-3 rule. Now, when the price retraces without making a new low, forming the number 2. And when the price breaks above where the original 1 high point is, creating a new high, it forms the 3 in the 1-2-3 rule. Thus, the buying opportunity arises, which is the third buying signal in the 1-2-3 rule. Now, of course, the signal is also the most reliable one. So you see after the 1, the 2, and the 3. This is where we come up with our 1-2-3 rule. Now, although the content I just talked about is related to the 1-2-3 rule, although we have tried it, the 1-2-3 rule is a very practical buying, selling strategies. But we know that there is no perfect tactic in the world. There's no perfection. There's nothing that is going to be 100%. So there are some drawbacks in its application in practical trading. So number 1, trading opportunities for individual varieties are relatively few. Number 2, in some cases, the entry opportunities are not ideal. Now, this is for aggressive traders. Some people like to enter at all the points of making money, right? Number 3, this rule is mainly for capturing trend-oriented trading opportunities. So it is not very suitable for short-term trading at all. It's going to be hard to find intraday trading charts that's going to look similar to this, right? Now, since a complete trading strategy includes entry points, stop loss points, our take profit points, risk control, and money management, and amongst others, the 1-2-3 rule can only solve the entry problem. So it can only be a part of a complete trading strategy. So when we know the shortcomings of the 1-2-3 rule, we can avoid the troubles of these shortcomings to bring us actual trading data, right? And by avoiding these drawbacks, we can further improve our trade effectiveness. Now, of course, this is also the basis for increasing profitability. Now, when you are executing your trading strategy, this entry point has to be a part of your trading strategy, right? There are other factors, there's going to be other things that is going to be implied into your everyday trading. So that is all we have for the 1, 2, 3 rule. It's a good little refresh and a good little add-on to our Dow theory that we've learned in the past. So lots of material to go over. Kind of look at these graphs, compare it to some of the stocks that we've been looking at. Kind of see if you could figure out, maybe pull it out into a larger time frame as well. Play around with these, get comfortable with these patterns, with these analysis, so that it's pressed into your memory, right? So that is all we have for today's online course. Please, this is going to be important. Go over this content, memorize it as much as you can, cross-reference it with other charts and things like that, and apply it to your real-life trading strategies. Our next online live class is going to be scheduled for next Tuesday, May 28th at 8 p.m. I hope to see everyone here again. Thank you so much for your support, and I'll see you all next time.